Our process for reading the market involves a top-down approach: index, sector, then stock. We also apply our three-legged stool analysis, focusing on macro, fundamental, and technical factors. Let's begin with Section 1, the market flim-flam. We will explore why the tape provided a misleading signal on Friday. The screen showed several alarming technical signals, such as the 55-day moving average break and bearish crosses. However, these are just symptoms, not the underlying reason for the market's movement. Retail investors often see a bubble or demand destruction, but the reality was a forced, calendar-driven rebalance, where institutions sold into the liquidity provided by panic selling. The narrative that the AI trade is over simply doesn't hold up. When the engine is clean but the chart looks broken, it's a signal to pay closer attention, not to sell. People blamed three specific things for the downturn: demand destruction for Micron, peaking hyperscaler capex, and a bursting bubble. Each of these claims is rebutted by the actual data. We define this event as a mechanical flush. Forced sellers dump assets on a specific date, triggering momentum models, which leads to further selling until the realization that the fundamentals are unchanged. Everything on Friday traces back to two primary mechanisms: the massive pension and insurance rebalancing to the tune of $165 billion, and the record-breaking Russell rebalance. Moving to Section 2, we discuss breadth divergence. During this event, price was dropping, yet the market's internals actually grew stronger. When you look closer at the breadth, you find that the selling was concentrated rather than broad. This reinforces the idea that what we saw was a flow-driven event. Internally, the market remained firm. Short-term and intermediate breadth held their ground, while long-term participation continued to rise, contradicting the idea of a broad market breakdown. This chart illustrates the positive divergence. While the index price was trending downward, market breadth was actually trending upward, serving as a key tell. We see that closing below the 50-day average, while breadth improves, is rare. Typically, breaking the 50-day average leads to price rollovers, but when it happens with strengthening breadth, it is a flow-driven rarity. You can verify this pattern yourself by looking back at 2025. This repetitive sequence of breaking a level and then recovering suggests that structural factors, rather than price alone, are driving these movements. Despite negative headlines, 200-day breadth is actually strengthening. This improvement in the internals, occurring while other headlines suggest a market crash, is a clean and important signal. A positive divergence like this is a gift, not a warning. It indicates that index drops are driven by a select few heavy names, providing a clear roadmap rather than signaling systemic risk. Section 3 examines the $165 billion flow. This movement is primarily driven by pension and insurance fund rebalancing. The market saw significant shockwaves estimated at $165 billion, stemming from quarter-end, month-end, and June-end rebalancing. This mechanical event, not specific company news, moved the tape. We are currently observing one of the largest rebalancing prints seen on the charts, rivaling the significant June 2023 event. It is crucial to distinguish cause from coincidence. Funds use the liquidity of a known earnings event to execute large-scale rebalancing, causing emotional selling among those who didn't understand the mechanical nature of the trade. Now we look at the equity risk premium, or ERP. This is the difference between the S&P earnings yield and the 10-year note, representing the return investors' demand for holding stocks instead of risk-free treasuries. A key trigger occurred when the ERP flipped negative. When it drops below zero or further, it forces institutional funds to reconsider their asset allocation. Pension and insurance funds operate based on specific return assumptions. They are not stock pickers. When the market hits these triggers, they move to rebalance their portfolios mechanically and on schedule. Essentially, when the ERP reaches zero, the benefit of holding stocks over bonds disappears, prompting a shift into bonds for better risk management. The question for any board is simple: why hold the added risk of equities if the earnings yield no longer compensates for it? This rational rotation at scale is what many investors felt on Friday. Data shows that equity allocations crossed above bond allocations around 2023, setting the stage for these types of mechanical rotations. June 2023 serves as our primary analog for current market activity. By studying the tape from that time, we gain better insight into how these mechanics play out today compared to other historical periods. We are seeing an unprecedented shift in institutional portfolios. Funds currently hold their lowest levels of cash while having record-high allocations to alternative assets. This creates a liquidity bottleneck. Because these large alternative assets like private equity and credit are locked and cannot be sold quickly, these funds turn to the most liquid part of their book, public equities, whenever they need to raise cash. These institutional funds frequently underperform their benchmarks. When their equity portfolios finally show a profit, they tend to lock in those gains immediately, regardless of the underlying company's long-term health. If an equity position runs hot and hits their predefined targets, they cut it. This isn't a negative verdict on companies like Micron or the AI sector. It's simply a fund executing its mechanical exit strategy. We identified these net sellers before the market move. While others focused on earnings headlines, we understood that big money was simply trying to exit billions in position size without crashing the tape. These funds don't wait for a specific magic date. If an event like a major earnings print provides enough liquidity to sell into, they take it. This explains the heavy selling we saw toward the end of last week. Ultimately, we are looking at $165 billion of calendar-driven rotation. The equity risk premium flip acted as the catalyst that broke the charts, turning equity holdings into bond rotation. Moving to Section 4, we examine the Russell reconstitution. This specific week featured the single most significant rebalance in the history of the index. A massive run-up in prices meant that many companies outgrew the small-cap threshold. As they graduate to the Russell 1000, funds tracking the smaller index are forced to sell them all at once. The numbers behind this are historic. 43 companies graduated out, 165 names crossed the cutoff, and 6 companies now exceed $20 billion in value, forcing immediate liquidation by indexed funds. Because they were booted from the index, every automated tracker was forced to sell. We saw volume print 5 to 10 times higher than average. That wasn't market sentiment, it was just basic plumbing. Ironically, the names that cratered were not laggards. They were the index's best performers, which is exactly why their forced exit caused so much visible damage to the charts. The top 5 graduating names were up over 400% on the year. To an outside observer, the sudden drop looks like a trend reversal, but to those tracking the rebalance, it was merely a scheduled graduation. This casualty list of names being booted from the index created significant volatility. Observing price action alone during these events often misleads traders into thinking the trend has broken. Take a company forced to dump 60 million shares. If the price drops from 350 to 250, nothing fundamental has changed about the business. It is a classic liquidity trap versus a buying opportunity. Let's break down the compounding effects of the current market situation. We're looking at a combination of thin floats, index unwinding, and pension overlaps, which are creating significant pressure. While the primary unwind might be nearing its end, the rebalancing aftershocks can continue from Monday through Wednesday as funds mirror these adjustments. Avoid rushing. Map the second wave before you act. It's important to reframe how we view forced selling. A name being dumped due to an index change is a mechanical, temporary event, quite different from a fundamental business failure. In short, this is the greatest Russell rebalance on record. We have 43 companies graduating out, forced selling into thin liquidity, and major pension rotations, all hitting simultaneously. To get a clear picture of these drawdowns, we need to put the current market movement into context by comparing it to the last time a similar event occurred. Our methodology is simple. Compare the shortest comparable window. Using a shorter period helps minimize extraneous variables, ensuring we measure the core event rather than noise. When we compare the current 3.6% drawdown to the 2.78% seen in 2023, the data shows that this is consistent with historical rebalance patterns, not a market cliff. Some might point to a 5% drop as a sign of trouble, but that is extreme framing. An honest reading, based on specific time windows, places the drop closer to 3.6% to 3.9%. The Nasdaq is following the same pattern, with a matched window of about 4% compared to the 5.58% extreme peak to trough. It is a normal rebalance wearing a crash costume. Looking at bonds, specifically the 30-year, we see a yield drop of 4.5% compared to 5.3% in 2023. Like equities, this is a significant move but remains within historical precedent. Why use a short window? Because 2023 had unique factors like the start of the AI boom. Shrinking the window allows us to isolate the rebalance mechanism as the primary variable. The verdict? This is not a market cliff. It is a rerun of events from 3 years ago. The current drawdown is normal for this mechanism, even if the panic is not. Moving to the volatility regime, it is clear that with a new Federal Reserve chair and evolving rules, increased volatility is becoming a feature of the market, not a bug. While volatility is indeed elevated, it does not signal true panic. We are seeing a gradual rise in volatility rather than a sudden, extreme fear spike. Finally, looking at the ratio of Nasdaq volatility to S&P volatility, history suggests that spikes in this spread are often the wrong time to sell. as seen in late 2006 and mid-June. Let's turn our attention to when investors should actually start feeling concerned. A key indicator to watch is the spread between S&P and Nasdaq volatility. Normally, a jumpier Nasdaq compared to the S&P is expected. That's where the market beta lives. You only need to worry if this relationship inverts, with the broader S&P market showing more volatility than the high beta index. We are not there yet. Another area causing confusion is the rising average true range, or ATR. Here is how you should read these signals. A rising ATR indicates expanding daily ranges. While some might take this as a sign that the trend is over, these bigger swings are actually an opportunity set for traders who know how to navigate them. Consider the impact of the new Fed leadership. When the new chair was sworn in last May, the market eventually understood that the reaction function had changed, creating a new volatility regime. This new environment is great for active traders but brutal for those sticking to buy-and-hold strategies. The wider the range, the larger the edge, provided you are trading it correctly. It is important to recognize that we are operating in a trader's market. For a swing trader, however, this current environment can act more like a minefield. If you are trading it, volatility provides repeatable setups. If you are just sitting in it, extreme swings can easily ruin your strategy. It's a good time to rethink your approach. Our strategy in this climate is clear. Sell premium, use a hit-and-run approach, and size down appropriately. Manage your trades actively. Maintain patience and prioritize risk management. Take the volatility when it arises, but avoid forcing trades that aren't there. We are also tracking the theme of peak inflation. Recent data suggests that oil and gas are rolling over, signaling that the worst of the rate hike fears are behind us. Even with geopolitical tensions, crude oil prices have been under pressure. This indicates that the inflation impulse is likely spent, as the market is failing to rally on bad news. Gasoline futures have also trended lower. While this wholesale movement takes time to reach the pump, the clear downward direction supports the peak inflation narrative. With inflation peaking, the narrative surrounding forced rate hikes loses its fuel. This shift in the disinflation backdrop has significant implications for how we view various market sectors. For instance, home builders are a sector to watch. Since lower rates act as a direct tailwind, they become an interesting indicator for broader market health. Looking at capital expenditure, no one is cutting their budget. This is about market dominance, not immediate return on investment. The drive to stay ahead in search and platform share forces firms to keep spending regardless of the short-term macro noise. Key firms are heavily invested in this build-out. Google is raising significant capital for chip procurement. Meta remains committed to its long-term bets, and Amazon continues to leverage AWS. If they aren't cutting, the growth story is likely intact. It's impossible to build out this infrastructure without the toolmakers. The equipment layer is essential. As these firms ramp up, so must their suppliers, reinforcing the broader growth narrative. The supply side is acting as if demand is permanent. Look at SK Hynix, which is doubling production capacity over the next 5 years, and Samsung, which is operating at full capacity while offering massive retention bonuses to keep their talent. Intel also remains a dark horse in the memory space. We're keeping a close eye on their hiring trends, as an entry into DRAM could shift the entire industry landscape significantly. The power dynamics have shifted. The memory makers are now in control. While hyperscalers have historically called the shots, current leverage sits with firms like Micron and SanDisk due to the absolute necessity of their products. Apple's struggle to secure memory supply highlights this shift. When they can't source from blacklisted suppliers, their production is at risk. Keep these memory stocks on your radar for the next rebalance window. Moving into our playbook, we evaluate the market using our 3-part framework: macro, fundamental, and technical. Understanding how these interact is what we do to prepare for the week ahead. Applying this to our recent performance, the macro leg was impacted by pension and index flows. Fundamentally, companies like Micron crushed expectations. Technically, the charts are reflecting the flow, not a change in business value. The core principle is clear. The tail does not wag the dog. Flow and rebalancing cause technical movements, which then trigger psychological panic. By reading the flow first, you avoid being fooled by the charts. Looking at the index, sector, and stock level, the same lens applies. The index is down on flow, not fear. Semis are moving sideways as rotation occurs, and forced-out names are presenting specific entry opportunities. For our checklist this week, monitor second-wave rebalancing. Watch for capitulation versus potential bottoms in forced-out names, and keep an eye on breadth. Improving internal metrics are a positive sign. Our current posture is risk-off by design. based on our indicator stack. It's not about doing nothing, but about reducing size, protecting capital, and keeping enough dry powder to act when the setup reforms. Volatility is essentially a vending machine for those prepared to trade it. Mark your levels, hit the trade, step out, and repeat. Let the mechanical selling clear, and don't feel the need to chase the close. Thank you for reviewing the briefing. The tape will always show you a crash if you aren't looking, but your job is to look under the hood. Stay disciplined, and we'll see you in the next one.